President Trump is engineering what could become the second largest economic stimulus in American history. Not with stimulus checks, not with direct government payments, but with the Federal Reserve Bank, your mortgage rate, and a debt strategy so powerful and so dangerous that the last time America used it, it took nearly 30 years to fully play out. On May 15th, Kevin Warsh becomes the new chairman of the Federal Reserve. And what he does in the weeks and months that follow will directly determine what you pay for your mortgage, what your dollar buys at the grocery store, and whether your investments grow or get quietly destroyed by inflation. Today, I am breaking down the entire plan, the housing strategy, the economic strategy, the national debt strategy, and the investment opportunities this shift is creating right now. Welcome to Wealth Analysis Network, the channel that delivers deep, honest, research-backed financial analysis, so every person watching understands what is actually happening in the American financial system before they feel it. If you are new here, subscribe right now, because every single week we bring you the kind of analysis that most financial channels never go deep enough to provide. Today, we are going inside the Trump administration's Federal Reserve strategy, what the real goal is, how the housing market and the national debt connect to the same plan, and what it means for your money starting right now. Let's go through every layer of this. Let's start with the housing market, because that is where most Americans feel interest rate changes most directly and most immediately. If you went out today to buy a $500,000 home, put 20% down, and finance the remaining $400,000 with a 30-year fixed-rate mortgage at the current rate of approximately 7%, your monthly payment would be around $2,661. Kevin Warsh has said clearly that interest rate policy is housing policy, that first-time homebuyers are having a hard time getting a house, and that cutting the Fed's interest rates could get 30-year fixed-rate mortgages to a level where the housing market can start moving again. If mortgage rates fell to 5.5%, that same monthly payment drops to approximately $2,271. If rates fell to 4.5%, the payment drops to around $2,060, saving over $600 every single month, more than $7,000 a year, on the exact same house. That is the math behind why Trump has been publicly and aggressively demanding lower interest rates since taking office. Trump has been vocal and consistent, referring to Jerome Powell as too late and too slow, arguing that keeping rates elevated puts America at a competitive disadvantage and that the new Fed chair should deliver meaningfully lower borrowing costs. But here is the critical detail that most coverage of this story is missing, and it is the detail that changes everything about how you should be thinking about what comes next. Kevin Warsh has spent years criticizing the Fed's $6.6 trillion balance sheet, arguing it distorts markets. His plan to shrink that balance sheet while simultaneously cutting short-term interest rates could actually put upward pressure on mortgage rates even as the federal funds rate falls. This is the central tension in the entire strategy. Mortgage rates do not track the federal funds rate directly. They track long-term bond yields. And when the Federal Reserve starts selling trillions in bonds from its balance sheet, it creates more supply in the bond market, which pushes bond prices down and yields up. And when yields go up, mortgage rates go up with them. The buyers who build wealth through real estate over time are not the ones who perfectly timed the rate cycle. They are the ones who bought right, borrowed smart, and held long enough for the fundamentals to work in their favor. And that principle does not change because the Fed chair changes. Now let us move beyond the housing market to what is actually driving this entire strategy at a much deeper level, because the housing market is the surface story. The real story is about the American economy and the national debt. Here is the economic foundation you need to understand. The United States government collects approximately $5 trillion in taxes annually and spends approximately $7 trillion, running a $2 trillion deficit every single year that is covered entirely through borrowing. The total accumulated national debt now stands at over $39 trillion, and the fastest growing expense in the entire federal budget is not military spending, not healthcare, not Social Security. It is interest payments on that debt. With inflation remaining sticky and recent geopolitical shocks raising oil prices, The cost of servicing $39 trillion in debt is now consuming approximately 20 cents of every dollar collected in taxes, going entirely to interest payments that produce no services, no infrastructure, and no benefit to the American people. This is why the Trump administration is so aggressively pushing for lower interest rates, and it has almost nothing to do with housing affordability in the final analysis. If interest rates fall by even 1%, the United States government saves hundreds of billions of dollars annually on the interest it pays to service its existing debt. Hundreds of billions of dollars that could either be redirected toward reducing the deficit or, far more likely based on every historical pattern, spent back into the economy to stimulate growth. Trump wants lower rates primarily because lower rates make the debt problem manageable, create a refinancing opportunity for the federal government on $39 trillion of obligations, and free up spending capacity without requiring new tax revenue. The housing affordability message is politically powerful and genuinely real, but the national debt math is what is actually driving the policy urgency. Now let us talk about the historical playbook that this strategy is drawing from, because understanding the precedent makes the implications dramatically clearer. In 1946, after funding both the Great Depression recovery and World War II, the United States faced a national debt crisis that in many ways resembles today's situation. The debt-to-GDP ratio at that time was approximately 121%, meaning the country owed more than the entire size of its economy. Sound familiar? Today, that ratio is hovering at approximately 130%. The response in 1946 was not to cut spending. It was not to raise taxes aggressively. It was a strategy called financial repression, and it worked by doing two things simultaneously. The government kept interest rates artificially low, specifically below the rate of inflation, so it could borrow money at rates that in real terms cost almost nothing. And through a combination of regulations and incentives, banks, pension funds, insurance companies, and financial institutions were directed toward lending money to the government even at those below-inflation rates. The result was that by 1974, the national debt had not decreased. It had actually grown from $271 billion to $475 billion. But the economy had grown dramatically faster, from $222 billion to $1.5 trillion in GDP, which caused the debt-to-GDP ratio to fall from 121% all the way down to approximately 25%. The debt was not paid off. It was inflated away. The economy grew faster than the debt. And the people who were hurt most were savers, people holding cash, people relying on fixed income, people whose wages and savings could not keep pace with the inflation that the strategy deliberately maintained at a higher rate than the interest being paid on government debt. The question the financially sophisticated are asking right now is whether we are watching the beginning of a second financial repression, and if so, what that means for every investment decision you make from this point forward. Though Trump has consistently pressured the Fed to cut interest rates more aggressively, even suggesting a nominee's willingness to cut rates could be a litmus test for the Fed chair position, it has not yet yielded the desired results. And the administration's broader policies, including tariffs, introduce additional inflationary variables that could keep rates elevated longer than the White House prefers. But the direction of the strategy is unmistakable. Lower rates relative to inflation. More government spending injected into the economy. Debt-to-GDP reduction through economic growth rather than debt reduction. Savers and wage earners absorbing the real cost through purchasing power erosion. Investors in real assets benefiting as inflation drives asset prices higher. So what does all of this mean for you as someone who is trying to protect and build wealth in this environment? The answer comes down to understanding which side of the inflation equation you want to be on, and because financial repression, if that is what is coming, makes some people significantly richer and makes other people significantly poorer. It makes people who are sitting on cash and fixed income savings poorer because the real value of their money erodes every year at a rate higher than their interest earnings. It makes investors in real assets, real estate, stocks, commodities, inflation-protected instruments, richer because those assets tend to rise in value as the dollar loses purchasing power. On the real estate side, policy that gradually shrinks the Fed's balance sheet alongside lowering short-term rates could lead to stable or slightly lower mortgage rates, but the outcome depends heavily on where inflation expectations move and where capital flows go in response to Warsh's balance sheet strategy. If you are a homeowner sitting on equity that has accumulated over the last 6 years of rising prices, a refinancing environment created by falling rates could allow you to access that equity and redeploy it. Though doing so carries its own risks if spending that equity on consumption rather than investment reduces your long-term financial position. If you are looking to buy a home, experts do not expect mortgage rates to freefall when Warsh takes over. And even the most optimistic forecasts suggest only modest reductions this year, with the FOMC unlikely to move aggressively while inflation remains above target. On the investment side, the opportunities this environment creates are specific and identifiable. Broad real estate exposure through diversified REITs gives you access to the appreciation dynamic without requiring you to buy a single property directly. Home builder-focused ETFs capture the potential uplift from increased housing transactions if rates fall meaningfully. Gold and commodity-linked investments serve as a hedge against continued dollar erosion, not as primary wealth-building tools, but as protection against the specific risk that inflation runs hotter than official measurements acknowledge. Inflation-protected treasury instruments, TIPS, offer a way to keep pace with officially measured inflation on the fixed income side of a portfolio. And broad exposure to the American economy through S&P 500 index funds remains the single most reliable vehicle for participating in the long-term growth that financial repression historically accelerates, even as it redistributes wealth from savers to asset owners in the near term. Here is the bottom line on everything we have analyzed today. The Trump administration's Federal Reserve strategy is not primarily about making homes affordable. It is about managing a $39 trillion debt crisis using the same playbook America used after World War II: financial repression. Low rates relative to inflation. Debt grown away rather than paid away. Economic stimulus funded by money that in real terms costs the government almost nothing to borrow. The people who win in this environment are the ones who understand the mechanism and position themselves inside it. The people who lose are the ones holding cash and fixed income savings while inflation quietly reduces the value of every dollar they hold. Understanding which side of that equation you are on, and making deliberate decisions to move toward the right side, is the single most important financial move available to any American right now. If this analysis gave you a clearer and more complete picture of what the Trump administration's Federal Reserve strategy actually means for your mortgage, your savings, and your investment portfolio, please give this video a like and share it with someone who needs to understand what is coming. Subscribe to Wealth Analysis Network if you are not already part of our community, because every single week we bring you the deep, honest, research-backed financial analysis that helps you stay ahead of the system instead of being quietly hurt by it. Drop a comment below and tell me, are you positioned on the right side of what is coming, or do you still have questions about how to get there? I read every single one. See you in the next video.